Hi, my name is Caleb Mugendi. I'm a senior associate at Nabo Capital. Today we want to talk about the highlights in the equities market so far, given what has transpired in the year 2022. As we all know, we are experiencing a lot of geopolitical tensions following Russia's invasion of Ukraine, terming it an exercise that they are doing. And this has had reverberating effects across the globe. Some of the key highlights being the price of a lot of commodities has increased. We had the price of oil rising above $100 per barrel, and we also had an increase in a number of commodities, dislocation of the supply chains across the world, and a lot of geopolitical tension as Russia was brought as a lot of the West Africa, Western countries imposed a lot of sanctions on Russia. So this has had a lot of effects, especially in investors' perception of risk this year. This has led to a lot of volatility in a number of asset classes, including the equities market, equities asset class, and the equities market here and also abroad. So far, for the year 2022, the market is down close to 2%. It has actually held quite, it has still been supported, looking at what has happened in other markets globally. And despite the increase in volatility, a number of opportunities do and have emerged in the local Kenyan market. Looking at the earnings, we're expecting a lot of the banking names to release earnings this month, the month of March, and we do expect an improved performance from the banking sector. Just highlighting some of the results that have been released so far, we do have Stanbic Bank that has released its results, and we saw that the performance improved. They were able to lend more loans. The balance sheet registered growth, the loan book growing, and they also got a lot of net interest income increased as well. And this led the bank to propose a dividend of close to 9 shillings full, interim, given they paid around 1.7, and they added another close to 7.7, bringing the total payout to around 9%, dividend yield on the stock. That is a good, attractive opportunity that we are seeing. And we do expect this to play out in the other banking sector names as we proceed with this earnings season for this year. We do expect the earnings to improve again from reports that we had last year that the banking sector profits were, up until the month of October, were even greater than pre-COVID. That was in 2019 full year results. So we have a lot of expectations that earnings will continue to outperform. This is on the back of lower provisioning levels. As we saw that provisioning levels jumped as a lot of non-performing loans grew, especially during the pandemic period. So a lot of banks came into adjustments with their customers, some moratoriums here and there, restructuring of their loans, and that enabled them to be able to pick up lending in the last year once the economy was able to reopen fully, and businesses were able to get back on their feet as people came back to work, as we came out of lockdowns, and as we're trying to get back to the normal cycle of doing business. So a lot of volatility has come into the market, especially again owing to the geopolitical tensions. But as we said, that also presents opportunities for long-term investors who can take a long-term position on the market. As we do know, as a country, Kenya, we do have some ties with Russia and Ukraine in terms of our exports and imports. In terms of export and imports, we do have trade with these countries, and this has also been affected on a national level. However, again, some of this brings out opportunities. We do expect the effects to be felt with the rising oil prices. We expect inflation to also have a hit and start rising higher during the second part of the second half of the year. And with the high inflation also comes the possibility of the central bank tightening its monetary policy just in order to rein in inflation. So far, we've been more or less cushioned from this effect as the government has tried to subsidize the cost of fuel by not increasing it in line with market conditions. But we also are not too convinced that this will last will last until the end of the year, at least given again we do have an election coming up and a change of government. This might also have an effect on that temporary reprieve. So looking at the market, it's also good to try and keep focus on the key drivers. We have the corporate earnings that are coming up. We do also expect this year to remain earnings to still remain robust this year in the banking sector, again because we've already improved the base, so we do expect a slight slowdown in earnings growth this year. But also looking at the economic growth for the country, we also still expect a slight slowdown, again because of the supply disconnects and also the tensions, geopolitical tensions that may have an effect in the long run. But all in all, we do expect that economic growth will remain close to pre-pandemic levels, and this will still provide a support for industries that are closely connected to the economy. Again, lending to businesses will still do well this year. We also have the approval from for some banks, that is, on the risk-based pricing model by the Central Bank of Kenya. This will provide a slight uplift in yields, especially for the banks, since they will be able to price in more of the risk, from a client perspective, and also they will also be able to lend more towards SMEs and MSMEs who previously might not have fallen into their risk thresholds. So with the approval of risk-based lending, we expect the private sector credit growth will increase again this year. We had that as at last year, December, the private sector credit growth was around 8.6%. And we're hoping that this can increase to the double digits this year as this risk-based approval takes root in most banks. So with that, we do expect at least the economy to continue churning despite the shocks that we are seeing and a lot of volatility in asset prices as at now. A lot of investors are trying to weigh the sentiment of what's happening globally, especially foreign investors, trying to weigh the sentiment of what's happening globally and the decline or the volatility in equity prices, and figuring out which asset class to go for. But in the meantime, with a long-term view on the market, we still see a lot of pockets of value that investors can take advantage of at even more bargain prices. So at times like this, it's better to buy once, the saying is it's good to buy once there's blood on the street, but we're not yet there, though. It's something that you can use in your investing, and don't keep calm and take a long-term view.